Ever wonder how to make your money work harder for you, instead of just sitting there in your bank account?
The question we've all probably asked ourselves at some point,
Oh,
right?
absolutely. And it doesn't really matter if you're just starting out in your career or if you've already got years of experience under your belt.
Definitely. That's why we decided to really dig into this whole world of investing and wealth building.
Yeah, we've been looking at a ton of different resources, like everything from guides for absolute beginners to like advice from folks who've built some serious wealth.
Oh yeah, we even checked out some stuff specifically aimed at teenagers who were just starting to think about investing.
Exactly. So, with this deep dive, our goal is to sort of break down the most important concepts in a way that makes sense, even if you've never really thought about investing before.
Right, because let's be honest, the world of finance can be pretty intimidating with all the jargon and technical stuff.
No kidding. So, we're going to keep things clear, focus on the key ideas, and hopefully give you some actionable takeaways.
And the cool thing is, all these resources we've been looking at, they approach things from different angles.
Mm.
Some are super practical, step-by-step guides, while others are more about, like, the big picture mindset of wealth creation.
And that variety is actually super helpful. It gives us a more well rounded perspective.
Absolutely. So in this deep dive, we're going to kind of weave together these different threads and help you see the connections between them.
Exactly. All right, let's jump into one of the most fundamental ideas that kept coming up, especially in the resources for younger folks.
Okay, I think I know what you're going to say. Time.
You got it.
Yeah,
The power of time when it comes to growing your money, it's honestly a game changer.
it really is. One of the videos we watched used this great analogy. Imagine a snowball rolling down a hill.
Okay, I can picture that.
The longer it rolls, the bigger it gets.
Yeah, because it's picking up more snow along the way.
Exactly. And it's the same with your money. The earlier you start investing, the more time it has to potentially grow and multiply.
So it's like giving your money a longer runway to build momentum.
Precisely. And this is especially true for younger folks who have something we older folks can't buy back: more time.
Makes total sense. And one of the things they often recommend for younger people, specifically teenagers, is to start with something called a custodial account.
Yeah, those are pretty cool. Basically, since someone under 18 usually can't open their own investment account, a custodial account lets an adult, like a parent or guardian, manage the account for them.
So it's kind of like a stepping stone to having their own account later on.
Exactly. And while there are usually limits on how much you can contribute each year, the point is to get that snowball rolling early, even with smaller amounts.
Now, where might someone actually invest that money within a custodial account?
Well, a lot of the resources suggested looking into something called low-cost S&P 500 index funds.
Okay, what are those exactly? I've heard of the S&P 500, but
All right, so the S&P 500 is like this index that tracks the performance of about 500 of the biggest companies in the U.S. And an index fund, based on that, basically means you're investing in all those companies at once.
so instead of trying to pick individual winners, you're getting a piece of the whole market.
Yep, instant diversification. And some of the sources mention that historically, the S&P 500 has had an average yearly return of around 12.58%.
Wow, that's pretty impressive. But of course, past performance doesn't guarantee future results, right?
Oh, absolutely. Investing always comes with risks, but that historical average does give you an idea of the long-term potential.
For sure. And these custodial accounts, they usually get transferred over to the young person once they reach adulthood, right?
That's right, giving them a nice head start on their investing journey.
Okay, so we've talked about the power of time and these custodial accounts as a starting point. Now, the stuff we looked at also had some really specific advice for different teenage age groups.
Yeah, it's pretty interesting how they break it down by age.
It is. So, for a 14-year-old, what was one of the key pieces of advice?
Well, the big thing they emphasized was that 14-year-olds, and honestly anyone just starting to think about their financial future, have this huge advantage. They probably don't have a lot of financial responsibilities yet.
Like they're not paying rent or big bills.
Exactly. And that opens up this really unique window of opportunity to try a bunch of different things.
To sort of explore their interests and see what they're good at.
Yeah. They might not be making a ton of money right away, but these experiences can help them figure out their talents and build skills that could lead to earning opportunities down the road.
Okay, so 14 is about exploring and building that foundation. What about 15-year-olds?
For them, there was this cool little life hack they mentioned.
Ooh, I love life hacks.
Me too. So the tip was to start asking for cash as gifts instead of, stuff they might not use or that loses value quickly.
That's actually a great idea.
Right. And the other thing they recommended was to get a job, even if it's just part-time.
Not just to earn spending money, though, right?
Yeah, the idea was to start building a little nest egg, to stash away some cash. One of the sources called it a launch pad for future opportunities.
Stash instead of just save.
Exactly. It's about seeing that money as something that can help them take advantage of bigger opportunities later on, like investing or starting a small business.
Okay, so 14 is about exploring, 15 is about starting to build that financial base. What about when you hit 16?
At 16, things start to get a bit more focused on developing specific skills. They really stress the importance of figuring out what you're good at and then actively building on those skills.
Like honing in on those talents they might have discovered during those earlier exploration years.
Exactly. And it doesn't have to be about expensive courses or anything. The key is to invest in tools or resources that can help them enhance those skills.
So if you're into graphic design, maybe you invest in better software.
Precisely. It's about using those teenage years to really become good at something that can offer value to others.
Because if you can provide real value, the earning opportunities will likely follow.
That's the idea.
All right, moving on to 17. This one was pretty specific and kind of surprising.
Oh yeah, this was a big one. Get your driver's license.
They really hammered that home, huh?
They did. Even if you don't need it for everyday stuff, having a license opens up so many possibilities.
Like, you're not relying on others for transportation, which can be a big barrier to certain jobs or side hustles.
It's about maximizing your flexibility and options.
Okay, so by 17, getting that license is a big step towards independence. Then comes the big 1-8, a major financial milestone.
Right, and our sources had a few key recommendations for what to focus on at this point.
First up, bank accounts.
Yep. Once you turn 18, it's time to open your own bank accounts that you control directly.
So not just sharing an account with a parent anymore.
Exactly. And they suggested having at least two. One for everyday transactions and a separate high-yield savings account specifically for your emergency fund.
Makes sense. Keep those funds separate. How much should you aim to have in that emergency fund?
The general guideline was 3 to 6 months worth of essential living expenses.
Okay, so enough to cover the basics if something unexpected happens.
Right, like if you lose your job or have a medical emergency.
They also mentioned looking for banks with minimal fees, right?
Oh yeah, those fees can really eat into your savings over time.
Definitely worth shopping around. Okay, the second thing on the 18-year-old checklist was to get a credit card. This one might seem a bit counterintuitive to some folks.
I know, right? It seems like we're always told to avoid debt.
But the sources actually challenged that traditional view.
Yeah, they made a good point that getting a credit card and using it responsibly is actually a really good way to build a good credit history.
And that credit history can be super important for things like getting loans or even renting an apartment.
Absolutely. So the advice was to use the card for everyday purchases that you normally pay for with cash anyway, like groceries or gas. And then, this is crucial, pay the entire balance off every single month.
No carrying a balance and paying interest.
Nope. That way, you're basically using the credit card company's money for free while building up your credit score.
Okay, so responsible use is key. What was the third item for new adults?
The third big step was to open an investment account. And not just any account, but one that offers tax advantages.
Like an IRA or a stocks and shares ISA, depending on where you live.
Exactly. These accounts let your investments grow without being taxed in certain ways, although there are usually limits on how much you can contribute each year.
And what's cool is that these accounts have become way more accessible. You can often open them online in minutes.
Yeah, and the whole concept of fractional shares has made it so much easier to get started, even with a small amount of money. You don't have to buy a whole share of a company if you can't afford it.
You can buy just a fraction of a share. Makes investing much more approachable. Okay, let's zoom out a bit and talk about the different types of investments out there. One of the resources broke it down into 3 main categories based on risk and potential return.
Right, it was a helpful way to categorize things. So you've got low risk, low return investments, medium risk, medium return, and high risk, high return.
Okay, let's start with a low risk end of the spectrum. What are some examples of those?
Well, those are the ones that are all about safety and preserving your capital. Think of things like basic savings accounts, certificates of deposit, CDs, and government bonds.
Those are generally considered pretty safe, right?
Yeah, they're very unlikely to lose value, but they also don't tend to grow very quickly.
So they're good for short-term savings or that emergency fund we talked about.
Exactly. It's about protecting your money not necessarily growing it aggressively.
Then we move into the middle ground, the medium risk, medium return options.
Right. These offer a bit more growth potential, but with some added risk. You might see things like corporate bonds, real estate, and real estate investment trusts, or REITs.
And REITs are basically companies that own and operate income-producing real estate, right?
Yep. So you're essentially investing in a portfolio of properties.
So a bit more potential upside than those super safe options, but also a bit more risk.
Exactly. And then we get to the high-risk, high-return investments.
These are the ones that can really make a splash, but also come with the possibility of bigger losses.
For sure. This is where you see things like stocks, also known as equities, cryptocurrencies, and investments in startups or new businesses.
So potentially big rewards, but also the potential for big swings in value.
And these types of investments are generally more suitable for folks who have a longer time horizon, a higher tolerance for risk, and are comfortable with the idea that their investments might go up and down quite a bit.
Okay, so those are the three main categories.
Yeah.
And regardless of which type you choose, one thing that came up repeatedly was the importance of understanding inflation.
Yeah, inflation can be a silent wealth killer if you're not careful.
It's basically the idea that the cost of goods and services tends to go up over time, right?
Exactly. So if your money isn't growing at least at the rate of inflation, you're actually losing purchasing power.
You're able to buy less with the same amount of money.
It's like your money is slowly shrinking.
So that's why it's important to have at least some of your money invested in things that have the potential to outpace inflation.
Exactly. Okay, so we've looked at different ways to invest, but how do we actually make our money work for us more actively?
Ah, you're talking about passive income.
You got it. This was a big theme in a lot of the resources.
And it basically means earning money without having to constantly trade your time for it.
Right. It's about setting things up so that the money kind of flows in even while you're sleeping.
Okay, I like the sound of that. And they broke down these passive income streams into a few main categories, right?
Yep. They talked about dividend-paying stocks, real estate, and businesses.
Okay, let's start with dividend-paying stocks. Those seem like the most passive of the bunch.
They probably are. So you buy shares in companies, often through those diversified funds we talked about, and then periodically those companies pay out a portion of their profits to their shareholders.
And those payouts are called dividends.
Exactly. And the potential returns mentioned were somewhere in the range of 2 to 8% per year.
Not bad for essentially just owning a piece of a company.
Right. And the cool thing is you can often reinvest those dividends to buy even more shares.
So it's like your money is making more money for you automatically.
That's the power of compounding. Okay, the next category was real estate.
And this is typically done through rental properties, right?
That's the most common way. You buy a property, rent it out to tenants, and collect rent payments.
And those rent payments become your passive income stream.
Precisely. The returns mentioned for this were a bit higher, maybe 4 to 10% per year.
But it also probably involves a bit more work, right?
Yeah, it can be more hands-on than dividend stocks, especially if you're managing the property yourself.
Dealing with tenants, repairs, all that stuff.
Right. You can hire a property manager to handle those things, but that also comes with its own costs.
So there are trade-offs. And the final category of passive income was businesses.
Yeah. Businesses have the potential for the highest returns, maybe 10 to 25% per year.
Wow, those are some serious numbers. But I'm guessing it also involves the most effort.
Definitely. While you can eventually build a business that runs more or less on autopilot, it usually takes a lot of upfront work and investment.
Like building a great team and systems that can operate without you needing to be constantly involved.
Exactly. So the word passive in passive income might be a bit misleading, especially for real estate and businesses.
Yeah, there's usually at least some active involvement required. And one source made a really important point about the role of passive income, especially when you're just starting out.
So they said that it's usually best to think of passive income as a way to supplement your active income, not necessarily replace it entirely.
So don't quit your day job just yet.
Yeah, it's about using that extra income you're earning to build these passive income streams that can hopefully give you more financial freedom and options down the line.
Okay, so we've talked about different ways to invest and generate income. Now, let's dive into some of the fundamental principles that can help you make smarter investment decisions.
Right, because it's not just about picking random investments and hoping for the best. There are some guidelines that can really increase your chances of success.
Absolutely. And some of the resources we looked at laid out some golden rules of investing.
Yeah, these are kind of like the foundational principles.
What was the first rule?
The first rule is to set clear and specific investment goals. You got to know what you're investing for, how much you want to achieve, and by when.
So not just throwing money at something and hoping it goes up.
Exactly. Without clear goals, it's kind of like wandering around aimlessly.
And goals can help you determine how much risk you're comfortable taking too,
Oh,
right?
yeah. That leads us to the second golden rule,
Mm.
understanding the relationship between risk and potential reward.
Which is basically the idea that the higher the potential return, the higher the risk.
Yep, it's like a seesaw. You can't have one without the other.
So you need to align your investment choices with your personal risk tolerance and financial situation.
And that brings us to the third golden rule, which is super important for avoiding those emotional investment roller coasters.
Okay, what's the third rule?
Only invest money that you can afford to potentially lose.
In other words, don't gamble with your rent money or your emergency fund.
Exactly. Investing should be done with money that you won't absolutely need in the short term.
Makes sense. If you need that money soon, you might be forced to sell at a loss if the market happens to be down.
And that can really derail your long-term progress.
So those are the three golden rules. Set clear goals, understand risk and reward, and only invest what you can afford to lose.
Solid advice. And speaking of solid advice, we also look at some wisdom from the legendary investor Warren Buffett.
Ah, the Oracle of Omaha.
He had some really simple yet powerful rules for investing.
Okay, what was his first rule?
His first rule was to remember that a stock is part of a business. He emphasizes that you're not just buying a ticker symbol or a chart, you're buying a piece of a real company.
So do your research and understand the underlying business, how it makes money, who its competitors are.
Exactly. Look beyond just the stock price and try to understand the fundamentals of the business.
What was Buffett's second rule?
His second rule was to use market fluctuations to your benefit. He has this famous analogy about Mr. Market.
Okay, tell me about Mr. Market.
So Mr. Market is this imaginary business partner who's always offering to buy your shares or sell you his, but his prices are often driven by emotions and irrationality.
So sometimes he's super optimistic and offers you a high price. Sometimes he's pessimistic and offers you a low price.
Right. And the key is that you don't have to trade with him every day. You can choose to buy when his prices are attractive and hold on to your investments when they're not.
So basically, don't let the market's short-term mood swings dictate your long-term strategy.
Exactly. And Buffett's third rule builds on this idea of taking advantage of market fluctuations. It's the concept of a margin of safety.
Okay, break that down for me.
So the idea is to buy a business for significantly less than what you believe it's actually worth. It's like building in a buffer to protect yourself from unexpected events or errors in your analysis.
So if you think a company is worth $100 per share, you might only buy it if it drops to $70 per share.
That's the idea. You want to buy at a price that gives you a good cushion.
Okay, that makes a lot of sense. And building on that, Buffett is also a big believer in investing in companies with strong economic moats.
Yeah, that's one of his trademarks. He looks for businesses that have durable competitive advantages, things that make it hard for competitors to steal their market share.
So think of things like strong brands, unique technologies, patents, or anything that gives the company a lasting edge.
Precisely. It's about investing in companies that are well-positioned to generate profits for many years to come.
Okay, so we've talked about some timeless investment principles. Now let's shift gears and talk about the mental side of building wealth. Our sources touched on the idea of a millionaire mindset. What are some of the key characteristics of that?
Well, one of the big things they highlighted was the importance of actively working to close the gap between where you are financially and where you want to be.
So it's not just about wishing you were wealthy, it's about taking concrete steps to make it happen.
Exactly. And a key part of that is understanding your value and how you can offer that value to others.
So what kind of problems can you solve? What skills do you have that are in demand?
One source put it really well. They said that the amount of money you make is often directly proportional to the amount of value you provide.
So if you can solve big problems for a lot of people, you're more likely to be rewarded financially.
And to figure out what kind of value you can offer, they talk about finding your value zone.
Okay, what is a value zone?
It's basically the sweet spot where three things intersect. What you genuinely enjoy doing, what you're naturally good at, and what other people are willing to pay you for.
So it's finding that perfect alignment between your passions, your skills, and market demand.
And when you find something that sits in that sweet spot, you're more likely to be both successful and fulfilled.
Makes total sense. So once you've started to figure out your value zone, what are some of the recommended vehicles for building wealth?
They talked about two main vehicles. First, you have your active vehicle, which is how you primarily earn money. This could be a job or a business.
And they specifically mentioned that service-based businesses can be a good option, especially when you're starting out.
Yeah, because they often have lower startup costs compared to, say, a manufacturing business.
Then you have your passive vehicle, which is how you invest the money you're earning from your active vehicle.
And this is where things like long-term diversified investing come into play.
Now, one source challenged the common advice about having multiple income streams.
Yeah, they said that while multiple income streams can be great eventually, it's often better to focus your energy on one or two key areas when you're just starting out.
So don't spread yourself too thin trying to do a million different things.
Exactly. Master one or two things first, and then you can diversify later.
And another interesting point they made was about the difference between obstacles and excuses.
Oh yeah, that's a good one. Obstacles are the real challenges that you'll inevitably face on your journey.
Like maybe you don't have enough capital to start that business you want, or you lack a certain skill.
Right. But excuses are the reasons we give ourselves for not taking action, or for giving up when things get tough.
So it's about recognizing obstacles as problems to be solved, not reasons to quit.
Exactly. And the final mindset concept they touched on was the compound effect of knowledge.
I love that term.
It's basically the idea that just like your money can grow exponentially through compound interest, your knowledge and skills can also compound over time.
The more you learn, the better decisions you can make, which can lead to more opportunities and ultimately more success.
It's a reminder that learning shouldn't stop once you finish school or get that first job. It should be an ongoing process.
Absolutely. Okay, so we've covered a ton of ground. For someone who's ready to actually start investing in the stock market, what were some of the practical first steps they recommended?
Well, the very first step, which was emphasized over and over, is to make sure you have that emergency fund in place.
That 3 to 6 months worth of living expenses stashed away in a safe, accessible account.
That's your financial safety net. Once that's taken care of, the next step is to choose a tax-advantaged investment account.
Like an ISA or a Roth IRA, depending on your location and circumstances.
Yep, these accounts can save you a lot of money on taxes in the long run.
And then it's actually time to start putting money into that account.
And these days, it's easier than ever to do that. Most investment platforms have streamlined the process.
You can often link your bank account and set up automatic transfers.
Some platforms even offer perks like free shares when you open an account.
Nice little bonus to get you started. And for someone who's brand new to investing, what did they recommend actually investing in?
The most common advice for beginners was to start with low-cost index funds, particularly an S&P 500 index fund.
So back to that diversified approach we talked about earlier.
Yep. It's generally considered a less risky way to get started than trying to pick individual stocks.
And a lot of the sources recommended setting up automatic investments too, right?
Yeah, the set it and forget it approach, you basically automate regular contributions from your bank account to your investment account.
So you're consistently investing, even if it's just a small amount, and letting the power of compounding do its thing over time.
Exactly. And it can be a really good way to build discipline and avoid those emotional investment decisions.
Now, the sources did briefly mention investing in individual stocks, but with a note of caution.
Yeah, they touched on things like fundamental analysis and technical analysis, which are ways to try to evaluate individual companies and predict stock price movements.
But the general consensus was that for beginners, it's usually best to stick with those diversified index funds until you gain more experience and knowledge.
Okay, so to recap the practical steps, build your emergency fund, choose a tax-advantaged investment account, start with diversified index funds, and automate your investments. Sounds pretty straightforward.
It really does. And what's so cool is that whether you're a teenager taking those first steps or a seasoned investor, a lot of these core principles apply.
It really is about starting early, understanding the fundamentals, making your money work for you both actively and passively, and having the right mindset.
So much of this journey is about mindset, isn't it?
Absolutely. It's about being willing to learn, to take calculated risks, and to persevere even when things get challenging.
So to wrap up our deep dive, remember the power of time. The earlier you start investing, even with small amounts, the more time you have on your side.
Educate yourself about the basics of investing and explore the different types of investments available. There's a whole world out there beyond just your savings account.
Find ways to not only earn active income, but also to build those passive income streams that can give you more financial freedom down the road.
And most importantly, cultivate a growth mindset. Be curious, be willing to learn from your mistakes, And don't let fear hold you back.
So, as you go about your day, we want you to think about this. What's one small but meaningful step you can take right now to start making your money work harder for you? Maybe it's setting a goal to learn more about investing, or looking into opening a high yield savings account. Or maybe it's just having a conversation about money with someone you trust. Whatever that first step is for you, take it. It's the beginning of your journey towards a brighter financial future.